Hello, everybody. Hope you've had a great week. Thank you for joining us for today's public webinar. Good morning, Jim.
Good morning. Good morning. If I make some funny noises, I've been up a while. I've had 2 Diet Cokes, so sometimes that elicits some funny sounds. Anyhow,
Oh, so you're hopped up in Diet Coke this morning.
I am. I fell asleep at 6 last night, and I got up at 2. I'm writing a new book, and I just find I write well when I get up, with nothing going on for early in the morning. What we're talking about that one of the one of the quotes that I find so interesting, and it's one from the original book. It's by W. Edward Deming. It is not necessary to change. Survival is not mandatory. And I keep thinking about that, about so many stories and conversations I have with people with the struggles they have with trading. Anyhow, a short commercial, and then we'll get to the markets because there's some interesting stuff this morning, and then we'll do another commercial later on. What we're advertising for right now is the intensive that starts on February 21st. Intensives run about 4.5 weeks, about 60 hours of instruction. You can get all that stuff off our website, but there is a prerequisite to take the intensive, and that's to keep it fair for people that have been with us for some period of time and taking multiple intensives. The prerequisite is the foundational e-course. Is that the name of it, Jen?
Yeah, Foundation and Application of the Market Profile e-course.
Okay, I never get the name quite right. That's just to give you a good foundation before you enter into the intensive. And you can see the schedule here. And they're all recorded, because our most asked questions is, will this be recorded? Yes, they're all recorded, because different time zones and some people have other commitments or have daytime frame jobs. What the best description I can make of what our whole educational effort is we attempt to merge market generated information with momentum trading. Momentum trading is the most, addressed way of trading there is, but it lacks context. What the market profile does, and the way we look at the information, is the way I look at it, we put context around momentum. I think it's a great combination. So we don't we respect momentum, but we think there's a deeper way to look at that. All right, Jen, let's go to the markets, and then we'll come back and I'll let you do an official commercial later.
I'll give you the screen. There you go.
All right. If anybody was with us when we did the commercial for the jobs report, one of the things that we talk about is watching the reaction immediately following the number. The larger traders come in probably about an hour early on days when there's significant information, because they know there will be enough volatility to make trading interesting. I just got an email from a client/friend that is with one of the major prime brokers, and saying this morning there was a 1,000 contract e-mini order, which represents, I think, about 300 million. And it obviously looked like somebody was caught the wrong way. So it's showing there is, when I say they come in, they look at these numbers, and there is some activity early. But what we said when we were watching the jobs report was that the hour of trading prior to the NYSE opening very often reveals some interesting information. On the jobs report, the market sold off And by the time we got to the NYSE opening, the sell-off had retraced itself. And we said, when that happens, that is usually a sign of strength in the market. I just finished that, and then somebody asked immediately, well, what do you think the market's going to do today? Well, I mean, and the market did go, we had some liquidation later in the day on the jobs number, but early on, the market did rise sharply. Now, today, we have a sell-off relative to where the market was prior to the announcement of the number. And we're 20 minutes, 23 minutes from the opening, and you can see it's working its way back up towards the overnight low. So again, there was some sell-off, but it wasn't a lot of follow-through. What is going on, at least what I think is going on in this market, is if you take a look at your last year's high, there is no excess on last year's high. Excess and balance are the two most important concepts we deal with. No excess just means that it doesn't mean that this can't be the lasting high. But when you get this, the market sold off because of liquidation, not because of new money selling, not because there was evidence that new sellers, aggressive sellers, came into the market. And very often you get the liquidation, but the market comes back to this level where there's no excess. An auction should go until the last buyer bought, and then you want to see sellers come in. You got liquidation, which are sellers, but you're not new money sellers. Now, at the same time, and I see probably as much contrasting information as I have seen in a long time. I have steadfastly, focused on the lack of excess from last year. But now, if anybody listened to the recording we put out last night, for the first time, we did a midweek update, and we did that midweek update prior to the release of CPI this morning. And what I commented on in there is that the market has gone up for 3 days in a row on decreasing volume. That is not a positive sign. So you've got non-completion on the upper end. You've got a rally going on, and you're getting weak volume. So the market looks to me like it's, the momentum, the trend was up last year. As I said before, what I think happened late last year, there were people that wanted to take profits, but they didn't want the tax consequences for last year. So as soon as the new year came around, they took the profits, and it forced the market down for the first several days of the year. But that profit taking is old business. If you're selling something you already own, that's old business versus what is a stronger reaction, which is new business. Old business and new business, making that distinction is very relevant to understand what's going on in the market. So I think we got that selling early in the year because people could then move the taxes to this year. But it wasn't joined by new money selling. Now, some of the momentum traders jumped on the selling from the liquidation and profit taking from last year and got caught. They got caught short, and now the market has rallied back. So I think we've got a real contrast. We have no real excess on the high up there from last year. We've got 3 days of rising markets here on decreasing volume, which is not a sign of strength, and weak references. So I have a very low level of confidence. Jen, let me take a couple of questions, then we'll do a commercial, and then we'll go back to the market.
I don't see any questions just yet. I still got people coming in here a little late. Somebody's asking, does Jim think this is new money buying?
No, I don't. Remember, I said it's 3 days. It's 3 days of the market going higher with decreasing volume. Now, you're saying new money buying. I'm not sure 100% what that is. I mean, because you can have a lot of short-term traders. See, the question, new money, it doesn't distinguish between strong money and weak money. Yeah, there's probably some new money buying, but it's probably weaker hands momentum traders rather than stronger. If you had stronger hands buying in here, you would more than likely be going up on increasing volume, not on decreasing volume. Okay, what else?
I don't see
Jen,
any other questions
okay, why don't
as
you
of
go
right
ahead
now.
and do your commercial, then we'll come back and talk about the market.
Okay, 1 second. Let me take back the screen. Okay, so I just always like to point out to new folks, if you're not familiar with our website where you can find things, but if you go to our website, jimdeltontrading.com, you can go to courses. Also, I'll just mention here on the homepage here, if you want to receive our emails, we don't spam. Basically, we only inform you when we've got a public webinar or we've got a course announcement or something of that nature. But our official YouTube and X websites are here. Watch out for imitations. They steal our images and things like that, and retweet our tweets and things like that, and then try to contact you for like crypto scams and things like that. We do not solicit for any such things, but go to courses and then you'll see that the intensive is featured up at the top and the schedule is there for you to download if you want to take a look at that. Posted in Eastern time, so adjust for your time zone, but this gives you a good idea of the special sessions that we have. Like there are book sessions that we do in every intensive. Of course, the order of things are being switched up this time around. But you can see here that we've got over 60 hours of live webinar time with you, and undoubtedly, I bet you something will get added or whatnot, because that's what usually happens. But as Jim mentioned, joining us for a live intensive, there is a prerequisite requirement of the Foundation and Application of the Market Profile e-course. You need to have that in order to qualify. The only other possibility is if you happen to take a full live intensive with us in the past, and we're able to research it and find proof of that, then you can be grandfathered in and join us. Right now, we do have limited time discounted bundles. You get a nice discount for purchasing more than one course. So if you haven't done the Foundation e-course yet and you'd like to do that and join us for the live intensive, you can get that here on our website for a nice discount. Our early bird pricing is ending this Sunday, January 14th, and then prices will creep up a little bit here and there from week to week as we get closer to the intensive. So purchasing early always yields you the best price. And if you're somebody who wants to purchase all 3 courses, then you get the most discount by purchasing that at this time. If you've got any questions, on our courses, you need some clarifications, by all means, you can contact us at dalton@jimdeltontrading.com or give us a call and I'd be happy to speak with you over the phone.
Okay, thanks, Jen.
Let me give you the screen back. There you go, Jim.
Okay, so you can see as we've got about 15 minutes to the opening. The market is almost back up to in the overnight trade and almost back up to the settle from yesterday. So historically, if we open up here, historically, that's at least initially a positive day to start with. One of the things I want to mention is that we talk about what defeats most traders. And there's a couple things in there. Probably when I make the comment that the most egregious error traders make is fading trend days. And it's something that cost me dearly for many years. It was a very, very hard, habit to break. Sometimes it's just, the market goes up and you think it can't go any higher and you short it. And then you have to cover. And a lot of times that shorting and covering, fuels the trend day. And sometimes, you missed it in the morning. So then you get mad and you do the revenge trade and short it. But we have found historically, I would say that's probably the number one thing that causes a lot of traders to lose money. Now, I've made that statement over the years, but I really didn't have any statistics to back it up. It's pretty hard to get your handle on it. There's a new book out called The Best Loser Wins, and it's an interesting read. Well, I think I think there's some things lacking in the book, but there are some very positive things. And I think one of the some of the statistics that the author has gathered has to do with trend days. And if I remember right, about a very high percentage of the traders continually fade trend days. And he's got some statistics to back that up. Another statistic that is very common in there is, and we get this question all the time, we're doing intensive, how do I stop myself from not letting my profits run? And that's huge. And the answer that I give to that usually isn't a terribly satisfying answer, because once you get in the habit of taking your profit too early, you form a habit. And habits are hard to break. Once they get started, they're very hard to unseat those habits. But one of the things this author shows is that short-term traders, while they had a win ratio of about 61%, they were net losers in a very high percentage of the cases, over 90% of the cases. And so much is tied to that not letting your profit run. The market starts, you get a trade in your favor, and you can't, the fear of letting the profit get away from you overwhelms your logical sense, and you take that profit. One of the things that I'm talking about is I'm saying we're writing a new book, and an awful lot of the new book has a very strong orientation towards the self-understanding, understanding how habits are built, understanding how habits are changed. The initial book that I wrote was Mind Over Markets, which was a combination of market understanding and self-understanding. I've said all along, it was light on the self-understanding portion because I really didn't have that experience. And now, 30 years later, I've gained a lot of experience. So the new book is heavily oriented towards that. But the fact that I'm doing this writing right now, I think, is going to make the coming intensive far more productive for a lot of people, because all of this information is front and center in my mind now, and the understanding of habits and neural networks and how we form these habits, how we might address these habits, is front and center. So I think it's going to be a totally different perspective than any intensive we've previously done. Jen, let me take some questions.
Okay. Somebody's asking, do you augment market profile with any kind of breadth measure?
I do not. One of the things also that I think you'll find is there's a difference between, so many times, for example, when you have a trend, say you've got a momentum trend going up, a lot of the indicators that you use, that overbought, oversold, with the trend, tend not to be very reliable in trending markets. They're much more reliable. They're much more reliable in rotational market environments. For example, right now the market's going straight up for the last few days, and I say on decreasing volume. So all those things are negative, but you don't fight the trend and you don't fight momentum. Okay, what else?
Okay. On a higher time frame, do you have any comments on the 9 weeks of one time framing up into the end of the year? The summer volume was easily bought through on low volume, which seems to suggest the lack of committed sellers.
I think that particularly late in the year, everybody got behind the dream of the year-end rally, and and the buying took place. I mean, I think last year's rally was about as poor of a rally as I have seen in some years. Historically, it gets retraced, and when it gets retraced, it's fairly ugly. However, you can go broke, and most people do, waiting for that, that break to come. One of the things that I stress in my teachings and my experience is that very often you are much better off being a little late getting into meaningful trades rather than too early. But people, FOMO, I think FOMO is probably among one of the biggest causes of trader losses. You can sit down and like the question was asked here, suppose I see the market's weak. And do I see the last 3 days are weak? Yes, I do. But if you want to get run over, trade against the trend. Like I say, it's hard. FOMO, you're so afraid you're going to miss the opportunity. But I continually advise you're better off being a little bit late rather than being early. Because these markets go, and traders do what works until it doesn't work anymore. And as you made the comment, last summer, the market wasn't a particularly good market from a volume standpoint, but guess what? Without sellers, it's not going down. And a lot of times, people are very content just to let it go until selling comes in. So I strongly suggest you're so much better off being a little bit late rather than a little bit early. On the confessional side, I'm licking some wounds this morning because this market was so terrible. I couldn't resist twice. Twice I went against this, and twice I had to take small losses in the market, just because I said it's not going down, and that's a discipline that you have to work on. So it starts with understanding markets first, and the market, the trend is up. I think the biggest piece of information is that the fact that there was no real clear excess at the end of last year. Okay, what else we got?
Okay. Could you somewhat expect decreasing volume into large news events like this morning?
Not necessarily. Not necessarily. Matter of fact, it's sometimes you get a little bit more. The crowd is sometimes the crowd's pretty smart. So, but don't forget, you've also got you've got PPI tomorrow, and then you've got the big banks start reporting earnings tomorrow. And I think Citibank is one of them. Citibank has kind of pre-reported that they're going to, I think they're going to be a little soft on the earnings. So you've got a lot of additional information coming tomorrow. So you're at or within striking distance of the all-time high. You have more information coming tomorrow, and then you've got I think you've got the first FOMC meeting of the year, I think, is on the 31st. So there's a lot of uncertainty in this market. The trend is clearly up. The trend is clearly up. Too many people lose money because they get too anxious and afraid they're going to miss the trend. I don't think it's a very good trend, but the trend is up, and there is no sign of excess on the highs. Final questions?
Okay, somebody's asking, do you use day volatility with volume?
No, I do not.
Or only volume?
There was no real great place to get volume. I tell the story years ago, when I cleared locals, we had a local that made $5 million in commission one year because he was doing business for one of the very big hedge funds, as they were trying to disguise their business. And nobody expected that this broker would be doing public business. They thought he was just, nobody paid attention to him. Well, think how many years ago that was, and how the longer term has learned to disguise their business. And there's also many other ways that trading that orders are executed today. My comment is, if the longer term traders or investors let you know what they're doing, you probably don't want to know in there. So no, what I do, I look at the VIX. Well, I think the VIX is a flawed index. I do look at the VIX to see what the what the volatility is. And because the VIX is an index that is really keyed off of put buying, it does tell me if the longer term money is doing a lot of hedging. They're doing a lot of hedging. They're a little bit hesitant about the market. The currently, it doesn't demonstrate that. Okay.
Okay. While I agree completely with the concept of letting profits run, isn't the time you spend in a trade increase the risk? So if you're a scalper, wouldn't it make sense to trade nimble?
Well, depending on how you define scalping, uh, I'm writing in the new book that I think scalping is probably one of the least productive ways you can possibly trade. Now, everybody's got a different definition of scalping. The official definition of scalping took place on the floors of exchanges years ago. And when we scalped on the floor, we could buy on the bid and sell on the offer. And if we scratched a trade, we had very minimal commissions. As trying to scalp from outside, you're buying on the offer and selling on the bid. You're losing a tick both ways, and plus you're paying commission. So again, I am a non-proponent of scalping. It may sound sexy, but what I always say, if what you're doing is successful, keep doing it. I think the odds are pretty much against you. But again, everybody's got a different definition. Okay, another question.
Okay. Do you have any advice for when you're not feeling it and are just going through the motions? I know that obviously I shouldn't trade on those days.
It's embarrassing to me sometimes because unfortunately, I wish I didn't empathize with what you're talking about. What I had to do for years when I got that way, I had to actually get up and take a walk. I had to walk away. I had to walk away from the machine because it was like somebody putting a bowl of candy in front of you, which you shouldn't eat. But what's your favorite candy? So you just reach in and get one, and you reach in and get another. It is very, very insidious. But if you're not feeling it, your best thing is to get away because the chances are you're going to do something silly and non-productive. Okay. All right. So we're going to open shortly. Remember, as I said, when the market sold off following the news, when the market has returned and taken that back, usually that's a sign of at least a strong start to the market. The trend is up. It had no real negative effect. The real focus that I have is the all-time non-excess high. If we looked above that high, cleaned it out, and you found sellers, that would give me a different message. All right. Let me say thank you very much, unless you've got a final question.
There's several questions left, but it's okay. I mean,
Go
if you
ahead. I
want,
can
do you
take a
want to take
couple.
some?
I can take a
Okay.
couple. Yeah.
Okay. If a market comes down to an exacting location, I understand that it can be an indication that it was brought on by a short-term buyer. But does it not also indicate that sellers were not strong enough to sell through that exacting reference? Can it not be seen as weak on both sides?
No, I think that's a good point. And so what you do, the first thing you do is you stay with the trend. Don't fight trends. And as I say, for the last 3 days, there's been a substantial number of those weak references and declining volume. But remember what I said earlier, traders will do what works until it doesn't work anymore. And a lot of times smarter sellers will just step aside. They may want to sell, but they'll wait till it's over. I remember one of the statements that I've laughed at for years is some institutional accounts that needed to sell and wanted to sell, but one of the head traders said, "Well, we're not selling, but we've got our shoulder in the doorway." Well, what happens sometimes? There's an awful lot of shoulders coming through that doorway at the same time. So to answer your question, yes, there was no sellers to take it through, and that is important. You look at what's happening to value, you look at trend. And trading is an art, not a science. So you're nothing wrong with your observation. Okay, what else?
Okay, we'll take this as the last one then. How do you handle the information from the market when there's conflicting data? For example, I see the low from yesterday as weak since it was made at the overnight POC. At the same time, the highs are not strong either. Is it better to be looking at the long side and trade with value and trend?
Trade with value and trend. You want to put the odds, and this is a key point I'm writing throughout this book. Trade with value and trend. I mean, it's just, you may not like the trend and you may not like the things, but you're trying to put the odds in your favor. And your odds are going to be in your favor if you continually trade with developing value and with trend. Okay? And I understand, but remember, too many times traders think they have to trade. They just feel like, oh my God, I'm here, I've got to trade. Sometimes you have to walk away. If you don't like the market, walk away, because you'll start to do something silly and you'll say, well, this is just, I'm just going to do this little trade. And then it goes against you. And then you get locked into it. And all of a sudden, you turn a small trade into a bigger trade. Okay, so where we are right now before we leave, it's always dangerous. We have looked above yesterday's high. One of the most dangerous situations is you look above the previous day's high and then come back in. So I don't know if that's going to be meaningful, but it's certainly something you want to keep your eye on. So anytime you look above the previous day's high, come back in, you want to be very careful. So the market came down, it bounced off the settle. So it's probably pretty weak selling in here right now. There's no real volume, but you want to watch value. Value's building higher. So you want to watch that, and you want to watch, can you hold the high? If you hold the high, that's positive for the short side. If you don't hold the high, then you're clearly getting higher value. Let me say thank you very much. I hope you have a great trading day. Bye now.
Thank you, everybody. And yes, this has been recorded and we will post it once it's finished processing. Thank you, everybody. Bye-bye.